Hello everybody, and welcome to this video entitled The Most Undervalued Stocks in My Universe, growth stocks that is. This is not the best stocks in my universe, this is just talking about valuation, and today I'm doing this video on a Monday because I have been so busy, and so sorry about the delay if you were expecting it on Friday, but here it is. So, as a quick reminder, if you're new to the channel, in this video, the question that I try to answer, like I said, is what is the cheapest stock? But it's what is the cheapest growth stock? And so why do I care about growth stock? I care about growth stocks because I need to beat monetary inflation, which I estimate to be at 15%, and I'm trying to get a double. So really the goal of the channel and the goal of all these stocks is to try to get double monetary inflation at 30% growth a year. And the only way that you can do that is by focusing on companies that are innovative and that are beginning S-curves, right? That are really starting their S-curves. So that's why a lot of these stocks are for products that may not be very mainstream yet, because you don't want to invest in, say, the iPhone, in my view, because the iPhone is very mainstream. No investment advice, of course, but I try to invest in companies whose products are not mainstream at all. A few final things about the spreadsheet. I use enterprise value as my main metric. Why do I use enterprise value? Because a lot of companies have a lot of debt, and so if you use market cap, that debt is very misleading, or at least it's not included. You know, for example, a company like GM, they have well over $100 billion in debt. You look at the market cap, it looks cheap, but you add the debt back and you realize, wow, that's a very expensive company. So I penalize companies that have a lot of debt by subtracting the debt from their market cap, and that's how you get to enterprise value. And then I use gross profit. And why do I use gross profit? Because all of the stocks on this channel are typically not optimized for earnings. If they have earnings, they will have very high PE ratios because, like I said, they're not optimized for earnings because they're still reinvesting heavily in things like R&D, things like marketing, investing for the future, investing for growth. And one last point is the metric that I will refer to deem whether a stock is overvalued or undervalued is enterprise value over 12-month gross profit over revenue growth. And this metric is a modification of the PEG ratio, right? The PEG ratio is typically used for companies that are optimized for earnings, and Peter Lynch's PEG ratio. In this spreadsheet, I've modified it using revenue growth and gross profit, i.e. these stocks are all optimized for gross profit, so it makes sense to use gross profit instead of earnings because they're optimized for that. And then I use revenue growth because, again, I care about beating inflation and I want these companies to grow faster than inflation. And so this metric, EV over gross profit or over revenue growth, it asks the question, how much am I paying for each percentage point of growth? And you want to pay as little as possible for each percentage point of growth for you to be able to say that this stock is undervalued. And so it answers the question, how expensive is growth? How expensive is that growth for that growth stock? And let me get started with the actual ranking now. So the cheapest stocks in my universe are obviously going to be smaller caps, stocks that are kind of ignored by the market. So the absolute cheapest is HIMS, followed by StoneCo, followed by SAC. I will cover these stocks in a minute. What is the most expensive stock in the spreadsheet? And ta-da, to the surprise of nobody, Nvidia is an absolutely insanely expensive stock. You're paying up for growth like nothing else. I mean, it's unbelievable how expensive each percentage point of growth is for a stock like Nvidia. But Nvidia is not the only stock that is expensive. You have Shopify, that's quite expensive. The Trade Desk, that is also very expensive right now. And a few other stocks in the channel you'll find are pretty pricey. But these are the top three most expensive ones. And as I usually do, so as a reminder, you can just stop the spreadsheet, look at the numbers if you like my numbers and look at those numbers, or you can just listen to me go through the commentary. So I'm just gonna go through the commentary out of all of the stocks. So this usually takes a good 20 minutes, but let me go ahead and tell you what I think about each category of stocks. So the first category of stocks is the energy revolution stocks. Tesla and Enphase are my tier one stocks. They are my top stocks in my portfolio, my favorite companies right now. Enphase is obviously much cheaper than Tesla, more than twice as cheap as Tesla on a growth percentage basis right now. How much are you paying for that growth basis? Tesla is obviously, arguably, in my view, it is a more holistic. It is. I mean, will I go as far as say it's a better company? Yes, it's a better company. It's a more holistic company. It's got everything, right? Tesla's got a little bit of solar is a little meaningless for Tesla, but their battery product is the best, right? The Tesla Powerwall is the number one most famous battery product. Enphase also makes a battery wall product, but Enphase specializes in microinverters. So they specialize into that little box that goes under each solar panel. Tesla doesn't do that. Tesla has their own system of inverters that they sell, and they have their solar tiles that they sell. But I think it's not as good for solar. Enphase to me is the clear winner of solar. But Tesla is not a solar company. Tesla is an electric vehicle company, an artificial intelligence company, a self-driving company. They have so much going for them, and of course this stock is heavily covered on YouTube, so I don't need to go much into that. STEM is very interesting. So STEM is an installer of Megapack. The Tesla Megapacks are installed by STEM. Actually, STEM is Tesla is the number one supplier for STEM, and STEM also installs a lot of Chinese Megapacks. And STEM, on the other hand, competes with Tesla because Tesla has its energy management software called AutoBidder, or the Tesla Energy software, and STEM has Athena, which competes directly. So STEM is an interesting company in that they're both a customer and a competitor of Tesla. And STEM is obviously the cheaper stock in there, but it is a small cap stock. It is a stock that has a very low gross margin despite the growth. Interesting company nonetheless. All right, the two next companies in the spreadsheets are HIMSS and Teladoc. So HIMSS is a mix of a digital pharmacy with digital doctors, digital providers. It's a company that operates fully outside of the healthcare system. It doesn't take insurance, and it focuses typically on recurring issues that you need to get treated for years, and issues that are usually not covered by the healthcare system. For example, hair loss is the big one, but they also have products on stress and other matters. Teladoc, on the other hand, Teladoc is an older company. It's been around for a long time, right? Teladoc, telephone. That's why it's called Teladoc. It's been around for a while. It's a company that is not growing as fast, and I believe the reason why this company is not growing fast is because they are caught in the red tape of health insurance and healthcare, and they provide services through healthcare companies, and insurance companies. So it's not as agile in my view. And Teladoc was a darling of 2020, and the stock has had a vertiginous drop, insane drop. But the problem with Teladoc, in my view, is that they've done a bad acquisition. Livongo has shown that management really did a mistake with Livongo, and so management, I believe, has shown its true colors, and the company, will see how the company does in the long run. But for now, they are suck on to HIMSS, in my view, and I am very big on HIMSS on the channel. I've covered HIMSS multiple times. Let me move on to the data warehouses and data monitoring stocks. I have 4 stocks: Datadog, Snowflake, Palantir, and MongoDB. Really briefly, Datadog is an infrastructure monitoring company where it gets a lot of data points, billions of data points about servers, about your tech stack, and whenever there's an issue in the tech stack, you can learn about it through Datadog. So that's what the software does. And growth has stalled quite a bit, which makes the stock a little expensive right now. Snowflake, growth has stalled a lot at Snowflake, and so we'll see in the long run if it picks back up. But prior to 2022 and the whole crisis in corporate spending that we've had in 2022, prior to that, this company was growing at well over double and was guiding much higher growth. So Snowflake still still a leader in what it does. And what Snowflake does, of course, it's a data lake and a data warehouse. So what they do is they allow companies to store their data in a cloud that Snowflake has created, which is the data cloud, and you store it in the cloud. And this has a lot of advantages. Of course, you have all of the regular traditional cloud advantages, which means that anybody in the company can access it, can modify it, can feed into it. Another big advantage of a company like Snowflake is the sharing of this data and data sharing with other companies directly on the cloud layer without having to go through APIs, or at least going much faster than APIs. So Snowflake, great company, great CEO, lots of it going for it, but the growth has really stalled and been disappointing. At least the guidance has been very disappointing. Palantir has been doing very well lately. It's up more than 50%. It's been doing so well because of the AI association, and a lot of the market is getting very excited about AI. Nonetheless, for Palantir, the same is true. The growth at Palantir has slowed down quite a bit, and we'll see if it picks back up. What I love about Palantir was the confidence of the CEO. The CEO a few years back, CEO was saying 30% a year over the next 10 years. That's amazing growth. You'll make an amazing return with that. We'll see if it picks back up. I own Palantir typically for the military business. I think the military business of Palantir, the Gotham software, is a really great commercial business. Still has to prove itself. Commercial business, in my view, Foundry is an option in the future. And then MongoDB. MongoDB is a NoSQL database. It's a database that's very easy to use, and that has a very strong community of users that love the product. And this stock has surprised a lot of people to the upside and keeps surprising people. And I like very much MongoDB, and it's an important position for me. Let me move on to cybersecurity. So cybersecurity, I have 3 stocks that I like. Cloudflare is what I call a VPN for website. It protects websites. It hides the IP address of website. Cloudflare is expensive relative to the other cybersecurity stock. It is a minor position for me, and Cloudflare has made a lot of threats. They claim to say that they're going to be able to get into zero trust. It's a company that's aggressively trying to grow in many different areas, which is why I think a lot of people are very bullish on Cloudflare. But it shows in the valuation. It is a more expensive company than other peers in the field. And if you look at the 2 peers, my favorite peers in the field are CrowdStrike and Zscaler, Zero Trust Security. These companies go hand in hand. Of course, CrowdStrike is the provider of endpoint security. It's a cloud antivirus software that you install on your laptop that learns from every single computer, every single node on the network. It learns so that whenever there's an attack on a computer somewhere at another company that's not even your company, the software CrowdStrike, Falcon 9, not Falcon 9, what am I talking about? Falcon gets updated. It gets updated and it allows you to be up to date. Zscaler, on the other hand, Zscaler is zero trust. So what is zero trust? It's the castle and moat approach, as they call it. So it isolates your computer, so that if your computer gets infected, other computers on the network won't get infected. And so they go hand in hand. One is to avoid fire in the first place, and the other one is to avoid spreading of the fire. That's the whole idea between those two. Let me move on to e-commerce. E-commerce is another major mega trend. E-commerce, of course, in the US, in Western Europe, very developed, getting more and more developed, and that's why if you look at a company like Shopify, which is a leading player of e-commerce in the US, it's a very expensive company at a 1.39. You're paying for our growth. Keep in mind, a lot of businesses are operated by Shopify. I mean, as far even the Tesla store, like all of the Tesla goodies, the hats, etc., the chargers, they're operated by Shopify. Shopify operates so many other websites, like for example, Figs. Figs is operated by Shopify, which is a stock I'll get to. All of the Kardashian websites are operated by Shopify. So many different. It's like they said, it's from your first sale to your IPO. you can build a company on top of Shopify. It's a very powerful company, but nonetheless, it's so expensive, and it's expensive because it's a Canadian company. So again, I think you have a lot of ease of access to Canadian investors that props up the stock price. But it's been a popular stock for a long time, so it's an expensive company, and that's why it's a smaller position. C Limited is doing very well in Indonesia. They have a company called Shopee, which is leading, which is really beating Lazada's Alibaba competition. It's called Lazada over there, and they're doing better than Lazada. They got a lot of things going for them. Only problem with C Limited is that the growth numbers are still hurt by the gaming division, because they have a declining gaming division because of their game Free Fire, which has been banned in India and has been banned in different places. So the problem is that it's not as clear of a story because of that gaming division. Then you have MercadoLibre. MercadoLibre is my favorite out of the three. They are the leader in Brazil and in 4 Latin American countries. They're really doing better than so many of their competition, and it's a company that's becoming culturally relevant to a lot of Latin America. They also have a great fintech division, a great delivery division, and a great advertising division. So MercadoLibre is a stock that I plan to continue owning for a long time, and that I've owned for a while. They are the leader in their field. Let me move on to the payments. I don't have much to say about DLocal and Square, except that they've come under attack by short sellers, and they are now tiny positions for me. Square is expensive relative to that growth. The growth expected for Square is pretty slow. I mean, in the US, everybody has the Cash App. Every small business in the US has roughly a Square payment terminal, and if they don't have a Square payment terminal, they have the competition, and they would have already switched already. So that's why the growth for Square is pretty low. That's not something that you see for a company like StoneCo. StoneCo is still growing pretty fast. They are in a duopoly in Brazil with PagSeguro, and in a country like Brazil, small businesses are very important, and a lot of small businesses need those payment system. And StoneCo also have a tiny QuickBooks style type of business where they help businesses do accounting, and it's a company that has a lot going for it. So I love StoneCo. It is the cheapest stock. It's one of my bigger positions. Let me move on to my chip makers. The chip makers are so expensive right now. NVIDIA, as I've discussed, I mean, yes, NVIDIA is powering all of these new AI chatbots and all of these new AI needs, recommender systems, generations, video game, etc. Yes, they're running all of these servers, AI training. Yes, you need so many GPUs. You know, you need 8 GPUs for every 2 CPUs. So yes, GPUs have a future. There's so much going for NVIDIA. It's an amazing company. It's the best company in that space, but the valuation, I just can't get behind the valuation. And maybe that is because I am not an industry insider. Maybe if I was an industry insider, and maybe if I saw the things that NVIDIA does, maybe I'd be inclined to still own it at this price. But to me, it's just so expensive. And you have AMD. AMD has ran up a little bit, but it doesn't ran up nearly as much as NVIDIA. And AMD is more diversified. They provide the chips for gaming consoles, for example. They have an embedded division where they provide the chips, for example, for the Tesla entertainment system and other setups. NVIDIA has a little bit of a GPU divisions, but they're doing very well with their CPUs. Their CPUs are pretty popular. But NVIDIA, if you look, for example, at the keynotes of NVIDIA, it's clear to me that they're kind of playing catch up to NVIDIA. So AMD is kind of playing catch up to NVIDIA, hence the valuation in my view. And this is an expensive stock for something growing at 18% a year. In my view, even AMD is expensive. The better deal is, again, the micro cap. The small cap is Indie Semiconductors. That's the better deal in there. It's growing pretty fast. It's got a very decent gross margin for such an early company, and for the semiconductor space, very high. The problem is, of course, is that they're selling semis to the competition of Tesla. So the question is, how much hope do you have in the competition of Tesla in the electric car space? Because what they specialize in is selling things like LiDAR solutions to the Tesla competitors. So if you think the customers of Indie are gonna, give Tesla a run for their money and sell a bunch of cars, then Indie may be a good bet. If you don't, then maybe Indie is a stay away type of stock. But interesting story. I've listened to their CEO. I've listened to a few conference calls. They have a lot of industry experience and a lot going for them. But it's tough to be the supplier of the companies that are going to be objectively, in my view, crushed by Tesla. That's kind of that's why I'm a little wary of it. But nonetheless, I own it. I own a little bit of it. Very tiny position though. Moving on to AdTech. So as far as AdTech, I have Pubmatic and the Trade Desk. Main difference is that the Trade Desk is a buy-side platform. So the Trade Desk is you have a bunch of company owners who want to advertise their products, and they go in there and they buy on the Trade Desk. Pubmatic is different. Pubmatic is a publisher platform. So Pubmatic is selling space, selling space for ads. Of course, these companies are not comparable. The Trade Desk is one of the better stocks to own of the past 10 years. It's had an outstanding return. It's got a great niche, a great gross margin. It's still growing very fast, and it's in line to really benefit from the coming back of advertising that has been gone throughout 2022 because a lot of companies just cut advertising in 2022. Pubmatic, smaller stock, riskier stock, but very cheap, very, very cheap stock. The problem with Pubmatic is that their growth has stalled. Their growth has stalled at 10%, and now Pubmatic is a value stock. I mean, it's essentially a value stock. It's if you watch a lot of YouTube, you may find a lot of Pubmatic on value investing channels nowadays. That's not that interesting. That's very interesting. It's like there's a few stocks that could fit both a value stock and a growth investor. Pubmatic, in my view, is one of them because growth is going to resume, and then that stock is dirt cheap. If I had earnings in there, you'd see it's dirt cheap and it's making earnings. So anyways, moving on to my lifestyle stocks or new stocks. That's I should have removed that. It's really just lifestyle stocks here. So you have Celsius. Celsius has been an outstanding stock to own. I sold Celsius after it had a big run up. I shouldn't have. I regret selling it. It is still the leader in the US. There is not a single store you can walk into nowadays in the US where you don't have a giant aisle of Celsius. You see people at the gas station. They don't go for the Monster anymore. They go for the Celsius. Younger people, teenagers, women. They love Celsius. It's doing so well. This drink is doing so well, and the partnership with Pepsi is really, really pushing that growth. At 67% estimate growth over the next 4 quarters, that's absolutely amazing. And 42% gross margin in the beverage space is amazing. There is this general wariness of investors with beverages, because it's so expensive. You need to get shelf space. It's a game of distribution. But because Celsius has this partnership with Pepsi, they've nailed that distribution. We'll see how it goes. It's a stock that I'd be interested in getting back in if it got cheaper. And so we'll see how it goes. Lovesac is a stock that has been absolutely battered by the stock market. What does Lovesac do? They do actually bean bags. I don't know if you've ever seen those things. They're very popular among younger generations. It's kind of a competitor to the recliner. It's a giant bean bag. It's got foam in it, and you can sleep in it, and you can do whatever you want in it. And it's interesting, watch TV. It's very, very popular with things like Airbnb. It's popular in workplaces. I mean, it's trying to be a competitor of the Lazy Boy couch, in my view. And they also have a very popular sectional product. And this stock, I mean, when you look at the stock level, like Lovesac, it's kind of crazy. I mean, enterprise value over gross profit is 2. You're paying twice gross profit. It's crazy. Forward gross profit, 1.28 times forward gross profit. I mean, and this is obviously a stock that's investing in marketing because it's in high growth mode. But keep in mind, what if the stock decided to stop growing and you remove that marketing? I mean, you would be getting to an absurdly cheap PE. So anyways, this is a stock that I like. Inspirational CEO as well. And the CEO has kind of achieved the dream of all designers, which is to create this reusable furniture that fits everybody and grows with you as you grow up and with your life. Anyways, very interesting stuff in my view. Figs is a stock that I've been disappointed in. The growth has not been that good. A lot of videos that I've made about Figs is about what they're doing. The playbook of Lululemon. So Figs is kind of trying to do what Lululemon did for yoga pants. HIMS is trying to do for scrubs. In healthcare, nurses wear scrubs. So Figs is trying to do that for scrubs. And if you look at the growth numbers, it's obvious that it's not picking up as much as say yoga pants must have picked up, in the early days of Lululemon. Now the question is, and this is why I'm not dismissing Figs entirely. The question is that lack of pickup in sales of scrubs, does it have to do because of the overhang of healthcare, right? Healthcare was booming in 2020, booming in 2021. It may be that those sales growth numbers are not doing too well because we have this overhang where, healthcare was doing so well in 2020, 2021. Nurses got all of their equipment. They had this rush in sales, this boost in sales, and now they're kind of going through this valley of despair because you've had this lopsided demand. You've had this tremendous volatility in that sector. By the way, this is a statement that I could also make about stocks like HIMS and Teladoc. Same thing. The healthcare space has been through peaks and valleys, and we've just exited a tremendous peak where it was so widespread, and now it seems like we're in a valley. So that's why it's hard to know. And I will publish as soon as I have time. I will publish on an actual proper analysis on Lululemon, because if you look at the numbers of Lululemon, they look really, really good, and they have not fully achieved their vision of creating a new brand. That's what companies like Figs or Love or Celsius do, by the way. With the internet, with the advent of the internet, with the end of television, right? The end of the evening news. Brands in the past, they were created through TV. You would tune into the evening news and you would see an ad, and then you would know to go to the store and buy that product because you saw the ad. But today there's an opportunity for new brands to be created. So this is part of a mega trend. Maybe this could be even a better name: lifestyle brands or neo brands. It's a mega trend. That's why I try to invest in those for the sake of diversification. Moving on to my cloud niche stocks. This is how I call those, cloud niche stocks. I have two of them. I have DigitalOcean and AXON. So DigitalOcean, what do? They are a provider of cloud services, AWS-like cloud services, but for very small businesses, for businesses that are not going to have major bills. And most of the product of DigitalOcean are $50 a month. That's the bulk of their product. They sell a cloud service for $50 a month. So we're talking about micro businesses that would register, and we're also talking about a lot of people who want to train in the cloud, and they want to learn how to use the cloud. So you have a lot of developers that use DigitalOcean. Company has carved a niche for itself. And the revenue growth for next quarter is not quite at 30%, but pretty close. And the gross margin is excellent. And the company is right in the middle, a little cheaper than my average stock, but roughly in the middle here. And AXON, the reason why I put AXON in as a cloud niche is because of their cameras for police officers. So they sell body cameras for police officers, and so they have this whole evidence management, video management system in the cloud. And so, of course, I like that very much, because the margin of the cloud service is much higher than their legacy services, which were mostly hardware. And this is an interesting company to study. Let me move on to neobanks. So why do we have neobanks? Why do we even care about neobanks? Well, obviously today you don't need a branch anymore. I mean, we may still use cash once in a while because you have a business somewhere that requires cash, and they say cash only. But this is fading away. Most Gen Z today do not use cash, and the generation after Gen Z will definitely not be using cash. They're born with phones with their hands and digital property and Robux and all of that kind of stuff. And thus we don't need branches anymore. And the end of branches and the advent of a fully digital, only digital bank and the digital brand associated with a digital bank, I have two stocks to embody that trend. The first stock is Nubank. Nubank embodies that trend in Latin America. They are doing so well. They're growing really fast and very inexpensive for that growth. And the company embodying that trend in the US would be SoFi. And SoFi is kind of the same way. They are growing extremely fast, adding a lot of members. Stock of SoFi has suffered because of its association with student loans. So although that student loan story seems to be finishing up, student loans are coming back. Debt forgiveness did not go through. Now, these were all great news for SoFi, and if you saw the Supreme Court news about the cancellation of student debt not happening, right, about them striking it down, the stock went down. Like SoFi was down 5% after that good news. So again, there is a little bit of overhang about the student loans. I feel like traders are owning this stock, and they're putting it in my student loan headline trading bucket. But anyways, if you're a long-term investor, it doesn't matter. And right now, Nubank is actually a little bit of a bigger position for me than SoFi. But I do have a big position in SoFi, and I like SoFi very much. I've covered the stock multiple times on the channel. I think it's a great company, really at the heart of its megatrend. Let me move on to the last type of business, which is platforms. So we talked about SaaS earlier, right? Software as a service, and all of these software as a service stocks, be them in big data or be them in cybersecurity. Software as a service is an amazing business. Platform is the other amazing business. I'm talking about two-party marketplaces where sellers produce their own products and buyers come on their own through network effects. And it's the network effect that pushes the buyer to come. I have 3 stocks in the platform business. I have Airbnb, Etsy, and Fiverr. Right now, my favorite is Airbnb. I've made a video on Airbnb. Airbnb, you need to be careful with the headlines. Sometimes they'll tell you Airbnb is doing horrible. Look at this city. This city's down, 45% on alltherooms.com, and then you see that the city is in the middle of nowhere. And you realize, well, why would that city in the middle of nowhere be down? Because there's been a shift in travel, right? Travel is like the swing of a pendulum. Right now, people don't want to go into the country anymore because 2020 and 2021 is over. So if you look at a company like Airbnb, if you look at the data in very large mega cities, like New York City, it's way up. And if you look at the country, it's way down, and it's sometimes bears, they cherry pick an area, and they tell you, look, they extrapolate this to the whole business. No, travel changes with trends. Travel depends on trend. There's some years where traveling some places is good or not good, and Airbnb is just this layer on top of trust. It creates trust between parties that could not be trusted before, right? Owners of real estate and people who want to stay for short periods of time in that real estate. That trust didn't exist before, and now that trust exists. And I'll finish with the theme of trust to talk about Etsy and Fiverr. And Etsy and Fiverr is the same story. It's the story of trust, right? Buying online, buying crafts online, custom-made products online. Why is Etsy shining? Why is it shining? Well, it's shining because you got prior reviews, and you got pictures, and you got assurances from Etsy that everything's going to be okay. And the same is true from Fiverr. You have samples about people who want to do small jobs. You can try people for small jobs before you hire them for bigger jobs. These platforms really monetize trust and create new demand for skills and for, in the case of Airbnb, capital that is out there, but that has been underexploited, right? Whether it's skill or capital, it really monetizes skill and or capital that has been underexploited so far because of the issue of trust. And these platforms have found a way to turn trust into money and to monetize trust. And this is it about all of the stocks. That was a lot of stocks. If you watched the whole thing, you're awesome. And I hope you're not too bored. And I've had this comment before that I'm repeating myself. Well, yeah, this is a weekly video, and these videos really help me find new people for the channel, right? Whenever I post this video, I get something like 60-70% new to the channel viewers. So that's why I introduce all of these nuggets about these stocks, because I've covered all of these stocks in depth. You know, if you're a regular follower of the channel, you're not going to learn as much because I have covered these stocks in great depth, in detail. But if you're new to the channel, and that's why I suggest... if you liked any of the nuggets or any of the way I think, go look at each video. I've done dedicated videos on each of these stocks, and I discuss them in greater depth. But the advantage of this stock is that it really provides exposure to my channel, and I love having new people and new subscribers, and I'm very grateful for your time and for you watching my channel. Very, very much grateful. So thank you so much. This was not investment advice, of course. This is just entertainment, as evidenced by my commentary today. I hope it was a fun commentary. Please like and please subscribe. Have a wonderful day.